E-Money, the greatest.
Hey, what up, B? How you doing?
I am good. How are you doing?
Good, man. Just trying to hone in on this, exit out that 1 minute, man. It's not for me right now.
Well, I don't think it's a time, bro. I don't think it's the time frame that really makes your trade. The loss that you had the other day, you weren't following market structure. The win that you had today, you were following market structure.
Yeah, I seen that. I seen that. It was I had a new indicator on there, and it threw me off. And yeah, I totally got that. But I still wouldn't have got faked out if I was on the 3 minute or 5 minute time frame. But I noticed that I'm like, it's really my fault. But still, the 1 minute has did me more, dirt than it has done me greatness. So I need to just, stick with the 3 minute for now. Yeah, my market structure was trash that time.
Yeah,
it's crazy how on Forex, like, one thing can really mess up your whole day. One little small mistake.
If you let it.
Yeah.
Like, think about Kobe in a basketball game, right?
Mm-hmm.
Kobe may have made mistakes in the game. Or think about Steph Curry going zero when he's gone 0 for 10 in the first half. Professional athletes, they tend to have amnesia. So as soon as, they make a mistake, they tend to forget about it. Now, some players let their emotions get into them, then they have slumpy or bad games. But the real great ones are the ones that are able to take those moments where they're frustrated and channel that into something positive. And that's how trading should be, right? Like, yeah, you're going to make mistakes when you trade. That's a common thing. You want to do everything you can to minimize the mistakes that you have. But if you do that, you'll be able to come back, because sometimes, you know what, right after your next loss is going to be your win. But ultimately, you have to keep the mindset of, I'm going to figure this out, or understanding it. But it's very hard to do that if you don't have a trading plan, because then you won't even know what you made a mistake on.
Exactly.
But if you have a trading plan, then great. What did you make a mistake? Oh, I know what it is. I'm not going to do it. And that also goes back to the conversation where I was talking with the guy in questions. I was just saying, look, if you really understand like what you're doing with your trading, you should be able to make a profitable EA, because you'll know exactly every rule that you follow and don't follow. I'm able to make indicators based upon the things that I do because I know my rules. And I also know what rules I'm probably likely to forget just due to human error, because let's be honest, you're never going to be 100% successful in trading. You're going to be 99, 97, but that's good enough because you're human. You're going to make mistakes. Right. There are days where I inadvertently break my rules and just be one simple thing I forget. And so now I just start saying, man, here's the things that I know that I might tend to forget. So let me go build an indicator that makes sure I don't forget that. Like the whole news rule thing. I think you had a loss on Monday. You took it inside the range of the news. Somebody did. I can't remember who it was.
No, I don't think that was me.
Yeah, it was somebody. I can't remember exactly who. But they took a loss with inside the range of news. It made sense. But for me, that was also something I would just forget to do. So I'm gonna have an indicator that's gonna literally draw the news range for me to remind me, hey, don't take a trade here.
Wow.
It's just little things, Sometimes we just need a visual reminder.
Yeah, I see a lot of people are trying to do like the EAs and stuff now.
Well, I mean,
big on that. Obviously, the profitable ones though, because it'll be crazy if somebody trying to do EA. It's not even profitable.
Yeah, I mean, if you don't have a profitable strategy, EA only does what it's told. So if you don't have solid rules and a profitable strategy concept or a flow of, following out your strategy, then you're going to make an EA that's going to perform just like that. So
So you didn't take no trades today, huh?
Nope, no for me today. Told you I wasn't trading till Wednesday.
Mhm.
I meant that specifically because I wanted to see what was going to happen with this bank thing, and I wanted to see what happened with inflation.
Yeah. So what? So hold on, let me go to today. So you're worried about CPI year on year and not CPI and not core CPI?
Of course, I'm worried about all, but
But which one you alluded to in the chat?
I was talking about headline. I did not think headline would come down that hot, come down that much.
Wait, what's headline? That's year on year?
Mhm.
Mm.
That's headline, and then core is well, core is always said core, and they say year over year is headline. So
Okay, so year to year is the major one.
not really. The most important thing is core. That's what the Fed looks at. Because core headline includes other categories that are susceptible to change, and I can't remember which is which, but core strips out some things. Core is the more stuff that's more sticky. So that's what the Fed is really more curious about more than anything.
Yeah, well, I gave $1 a push. I mean, it's crazy. When you told me like to stop trading news, I've been elevating my trading. Like it's like I like it's like today, like I woke up later because I don't care about news. I trade after it. I don't try to trade before. It's just like I don't even trade this stuff anymore.
You know, I've been telling people that for a long time. They think trading news is where they have to make money, and you can make more money outside trading news if you would stop trading news. It's literally just, it really comes down to that. But a lot of people do not believe me when I say that.
It just gives you more time. You don't, maybe you go out the night before, you can come up later to the charts. Like before I would just own the charts. Like I'm just like make it more of like accessible, or you get this time off. Like now it's like, it's more, I'm trying to go into my future self. This is something I would do in the future. Like, don't trade news, maybe stay out later that day, wake up later. It's just perfect.
Yeah. And if I was to sit there and had traded news today based upon what I thought would have happened, I would just lost money. It's not even just losing. You don't just lose money during news.
Mm-hmm.
You lose a bunch of money.
Yeah. I had that before.
What's up, Augie?
Hey, what's up, Brian? How are you doing?
I am good. But yeah, no, like because like when news hits, you're not just going to lose your money. You're going to lose double your amount because all the rush of orders. No broker is going to sit there and close you at the price you put in. So it's like literally just gambling. So.
Yeah, I'm going to Vegas soon. I wouldn't even gamble there because like I'd rather just maybe double my lot size in Forex than rather just gamble on the casino. Like I'm not gambling no more.
Oh, don't get me wrong. I love a craps table. So you can catch me in Vegas on the craps. But outside of that,
that's cool. But to me, I'm good because maybe because you're way more experienced than me, but I'm not. I'd rather just double my lot size on Forex. Like I'm not gambling, and maybe because I've done it so much, and I'm most likely I'll be losing more than I have won. So, and I'm in LA, so we basically go to Vegas all the damn time. So no, I'm cool.
No, yeah, I don't treat Forex as gambling. It's like pretty much there's two ways you can approach Forex. You can either be proactive, in which you expect things to happen and you anticipate them, and not anticipate them, but you plan for these things to happen, and that's how you look at the market. Or you can be reactive. I'm very much a reactionary trader. I'm not looking at a forecast the night before. I know the news is upcoming, but when it comes to when I'm off the charts, I am off. I do not care what happens. I don't care if it goes 1,000 pips in 5 minutes. There'll be another move the next day. All I have to do is wait patiently for it. When it comes into my reaction point, great. There was a 15R on CAD JPY on yesterday. There was a 13R on Friday. On Tuesday, on Thursday, there was like some 8R on GU. Guess what? I'll catch another trade this week. I'll catch another trade next week. I'll catch another trade the week after that. If not, I'll just wait until it comes. Like there's no scarcity. Like there's always going to be a market because there's never going to be no one world economy. So because of that, there's always going to be at least one thing against another. And you can make money for the rest of your life off that. So that's always going to happen. The easiest way to say it.
Factual.
So, I mean, you want to go gamble, go to Vegas, not Forex. Forex, you just wait. Like you don't have to trade news. You don't have to anticipate with news. It's even better when news and technicals align because it makes your trades even better. Like I took some trades, I would have closed certain places, I could hold them longer, and boom, they ended up, getting more profit. So, like, I don't know, it's not worth it to do the gamble and go gambling with Forex to me. But to each their own. Everybody has their own trading strategy. Everybody sees it their own way. So
I've noticed that too. I'm like, Newsday, oh, it's going ham. I've noticed lately, like for gold, when unemployment claims come out, it's going ham. It goes ham.
Yeah, no, definitely.
Tomorrow's a high news day.
Tomorrow is?
Yeah.
Because of what?
Core retail sales, PPI, Empire State.
That don't mean much. No, that's not really that important.
Mm.
PPI, we already know what's going to happen with PPI. PPI is going to come down because inflation came down. If inflation came down, prices had to come down. It's not really that much of a tell. Retail sales is important. Is slightly important. It's not as big as people make it out to be. I keep red foldering it, and it will have a medium impact on the market, but not that much. What's really shocking is going to be Thursday's interest rate raises for EU, and unemployment claims. Like they know people are going to spend money. That's it. And then next Wednesday's, what's it called? No, is it? Hold on a second. What day is it on? Yeah, it should be next Wednesday, right? Yeah, next Wednesday, federal funds rate increase.
Yeah, it's crazy. Unemployment claims is orange folder, but that's like a main thing right now.
Mm-hmm.
That's like a main thing right now.
That's why the folders don't mean anything because every website marks these folders sometimes differently. So what's more important is you understanding how the news is going to be impactful. Everybody knows what prices are going to be. So they're not really anticipating a change, but inflation, that's an unknown. Unemployment, that's an unknown. So.
Hey, Brian.
Hey.
So if you were to start back testing again, how would you do it? Step by step.
Same way that I explained it inside the Discord.
Is it in the resources?
Mm-hmm.
Okay. And there's videos on it too, correct? In the YouTube channel?
Mm-hmm. There are also videos too. So
Okay.
Basically the thing of backtesting, the point of backtesting is not to see if you get trades right or wrong. Most people get that wrong. The point of backtesting is for you to understand, can you follow your plan? And if your plan needs to change. You don't control your results, but you control every time you decide to press buy or sell or close a trade,
right,
or open a trade. So it's silly to a degree, in my opinion, to base your backtesting just because you got some wins, because you don't even need a plan to get wins. But just because you got wins in backtesting doesn't mean you'll get wins in a live market. Because you've seen some traders who are actually great backtesters, but they're horrible in the live market. Not because they're bad traders, just because they have not transferred whatever process that they do in backtesting to their live markets, and they alter things. And therefore, if you can't practice the same variables that you do in a backtesting a live market, then you're giving yourself false results. Like, imagine that you just threw the ball at the hoop in a basketball game, all right, in practice. But when you go to a real game, you shoot completely different. Well, your results will be different. So just because you were making shots, because you were throwing the ball at the hoop compared to you were trying to shoot it in a live game, it's not the same results. So just because you got the ball in the hole doesn't mean that you have a process to do that again and again. So you want you want to practice what you're going to do. So that's really the whole point of backtesting.
And that's why you create the plan's important too.
Yeah, because if you don't have a plan, then what are you evaluating your backtesting against? You're evaluating if you get wins or losses, which that is what you want, but
that'll come with
it's more important.
Following the plan.
Right. It should. If it doesn't, then you need to change your plan. Because if you do your plan 100 times and 70 times you lost and 30 times you win, then you're not going to expect that you're going to go to a live market with the exact same plan and get 50% wins. Like, it would be impossible. So it's a think that would be what you get. So what you need is you need a plan that you can follow. You need to practice that plan, and you don't need to stop backtesting until you've got to the point where you can follow that plan without making any mistakes. That's the whole point. You don't make one mistake in Forex is enough for you to take a loss. So
and it's also building discipline too, and creating that follow the plan type of attitude. That makes sense.
Yep. So that's what it comes down to, really. So
okay, good to know. Thank you.
Yeah, so that's how I would approach backtesting, guys. A lot of people hate backtesting, but there's a purpose for it. It actually becomes a little bit fun when you realize what the purpose for it is. Now, backtesting doesn't tell you if you're a good or bad trader. Don't ever think that. That's something that I had as a big stigma, a reason why I didn't want to trade, because I take losses like, damn, I suck. No, backtesting just shows you, hey, if you do this, this is what the kind of results you get. So if you don't want to get these results, just make a change. It's that simple. So it will improve your results. So it actually becomes fun. It's also something I feel like people should do every day just to stay sharp, right? I'll never stop trading, no matter what I do, because I want to stay sharp. I want to stay sharp on skills. Backtesting helps. Trading live market helps. But you have to understand also, you got to be able to be in control of your emotions, not let them override your decision making. So that's why some people say don't spend too much time backtesting, because it gives you have no emotion. But the thing is, if you get to the point of backtesting enough where it becomes automatic, when you get to a live market, your emotions don't have a way to take control over you, because you subconsciously tap into what your plan is.
That's real talk, because yesterday I backtested all of September, and today I seen my go-to move, and I said I don't care. I just did it, and I'm pretty sure that's because yesterday on backtesting I'm just clicking. That's my move. I'm clicking. I'm going. I'm clicking. I'm going. I did it. So yeah, I believe that's very true. That happened to me today.
No, I believe that, bro. To me, that is a serious thing. Like, everybody has a different way psychologically that they need to be able to manage their emotions. And so I'm not going to say any one way is wrong, but there are a couple of routes to victory that, are common. And I think that what's common enough, if you've practiced something over 500 times, like when you go to like a gym and you're playing a sport, you're in practice for hours if you're in coaching. But a lot of basketball players will stay after a game and they'll sit there and practice shooting free throws. And they'll practice it every day. They'll do over 200, 300 free throws. That's not what my dad made me do when he was coaching me growing up. So when I got in the game, I wasn't worried about the pressure of the shot. I wasn't worried about, how many points were down, if I could tie the game or win the game with a free throw. I was thinking about the process that I followed the last 1,000 shots. And it was what to do. And make or miss didn't matter. I followed the process. That's all you can do. But what happens is, I always feel like athletes are the best traders, by the way, just because they have the discipline, and military folk. It's just really, it's about making sure that emotions don't decide your decisions. Emotions should not tell you to get in the market. Emotions should not tell you to leave the market. It should all be dictated on something logical that you can see. And whatever it takes for you to get to that point of not allowing emotions to dictate your decisions, that's when you start getting into the top 1% of traders, top 1% of athletes, top 1% performance, period. That's all it takes. But like you said, people, like you backtest, you've seen it. So when it came to the market, you're like, this is what I'm looking for. Boom, you hit the button, no hesitation, because you know exactly what you're looking for. When you don't, that's when you have fear. That's when people hesitate. That's when people have FOMO and they just hop in moves because they don't know what they're looking for. Because a lot of times they haven't practiced it enough to know when they see it. Man, if I ended up, I'm playing basketball, I'm coming down, I get a pick and roll, and I see that my guy shrugs off of me, and then the guy that did the pick and roll shrugs off of him, I'm going to shoot the ball. It's an open shot. Like, I just know it every single time. If both of them come and swarm me, I'm passing it to the guy who did my pick and roll because he's cutting to the basket. Like, it's instinctually known because I practiced this over and over and over again, and I know that's how I'm going to run the play. So it's the same thing we got to do with trading. We got to run our plays when we see the right opportunity, and we know exactly when to shoot or not to shoot. So,
drop mic.
I mean, it's really simple when you talk about it. It's hard in execution, simple in theory, but you guys got to make it simple. It's whatever it takes for you. You know what works for you. You know what I'm saying? So that's what ultimately comes down to.
Right.
So that's the skinny on it. What are the questions you got for me, brother?
Not much today.
Good stuff. Well, I'm gonna give y'all some time back, and I'm gonna let y'all go. But this last week's with the bank stuff, it's really put more heightened attention on what the Fed is going to do for interest rates, because the Fed said they were going to go until things broke, and the banks broke. So, and then inflation came in lower today. So now that gives the Fed the green light to keep raising inflation or keep raising interest rates, which means, do we need more banks to crash? Like, what else has to crash now to stop?
Wait, so I be getting confused with this sometimes. So banks crashed, and then they bailed out the banks, right?
Nope, they didn't bail out the banks. That's the difference.
What am I reading then? So they didn't bail them out?
Nope. Let me explain the difference. In 2008, they gave money directly to the banks so that the banks could stay in operation. Silicon Valley Bank, Signature Bank, and Silvergate are closed. Those banks do not exist anymore. They are now owned by the Federal Deposit Insurance Corporation, or FDIC, or the Fed. What's going to happen is they gave money to all of the depositors in the bank. That's the difference.
They didn't bail the bank out. They just gave the money to the depositors, but the bank is officially closed. No more bank.
Right. Which means that everybody who invested in stocks in the bank and the management of the bank are fired, and they've lost all of their equity that was in the bank. So that's different than what they did in 2008. But
and what did they do in 2008?
They bailed out the banks so that the banks could continue to run. So those banks that were going to close are still running today, except for Lehman Brothers.
And which one is better to you? What do you see fit?
Well, I'm gonna say this: the Fed did exactly what they had to do in the situation, because it was more about who were the depositors than who was the bank management. The depositors were companies, not individuals, and the depositors were not going to be able to pay employees this week, next week, and the weeks after that. And that meant that they were going to have maybe tens of millions of people unemployed. So they had no choice but to bail out the depositors, which is what should have been done. But what they've done is created a scary precedence. This was the only option in the situation, in my opinion. You don't bail out the banks. That's why all the bank stock dropped. But what they did was, right now, before, when you put money in a bank, up to $250,000 was covered by the Fed. through what's called the FDIC, Federal Deposit Insurance Corporation. So you have insurance on your bank account. That's why people would say you can always put your money safely in banks. What happened in their situation was that 97% of the depositors at Silicon Valley Bank had over 250K, which means the insurance could not have covered almost 100% of the bank. So what the Fed did was a scary thing, is that they created a $25 billion lending facility that tells banks, hey, if you get into a situation where you have a bank run like what Silicon Valley had, and you don't have the money on hand, you can borrow more money from the Fed at an interest rate. Now, what that basically means is now all of your money in the bank is insured, not just 250K, because the 250K is covered by FDIC. But then if your bank can't cover it, they can just go borrow money from the Fed, which then causes a problem. That causes more inflation.
So today, when inflation came out last year, year on year was 6.4%. This year, this one came out 6.6%. So that means inflation went down year on year, which means is that saying the cost of goods went down?
Yes.
And what effect does that have on our economy?
That means that the price of stuff should be cheaper, meaning buying a car should be cheaper, getting an apartment should be cheaper, cost of eggs shouldn't be a meme, all those kind of things.
But that's a lie. Everything's high.
It's still high, it's just not as high.
So no, groceries is way more higher than last year.
Yeah, but you got to remember, it's a basket of items. That's why we look at the core. So when they say it's 6%, groceries could not come down, gas could come down, and that's enough to shift the entire balance of stuff. That's why you need to look and see what came down. Because what you're going to find out is that housing is still stubborn. Housing hasn't dropped in price. They're playing with gas because gas is one of the most easier things to control. And rents are slowly beginning to come down. Food prices still high. So the overall basket is still high. But something within the basket came down. And it's always good to look to see comparison what it is. The Fed is concerned about housing. The Fed is not concerned about gas prices, because there's very simple things that the government could do to be able to lower the prices of that. But it's not really something that they control. You call up OPEC and say, hey, stop producing. Can you produce a little more oil? Sure, that brings down prices. All right, you stop levying certain taxes on products. That brings down prices. Okay, cool. But housing, they don't have much control. That's why they keep spiking up interest rates. And companies doing buybacks, that's because they can go get cheap corporate loans. What do? Make it where people start spending the money more on employees or something like that, or make it harder for them to borrow money so that they don't expand businesses, so people get unemployed. When people get unemployed, then the demand goes down. That's why Facebook announcing today they're going to fire 10,000 more people helps the Fed, but it hurts people. So it's a delicate situation of what they're in for a lot of reasons. But this is what influences price. Price is kind of choppy today outside of gold. Gold jumped up because of inflation. Like when the dollar drops in value, gold shoots up, because people are now rushing to put their money in safe assets, because the original bank is no longer considered safe.
Yeah, and I was telling you, I've seen one time when the US dollar was going up and gold was going up too, like crazy. Like, I didn't understand that, but it was just like one time I've only seen that happen. It was like 2 weeks ago.
Yeah, no, gold is a hedge against the dollar. When the dollar goes up, people sell their gold.
See,
when
but
people buy gold, and that's what Bitcoin's becoming as well too.
I totally understand that, but you say it's a hedge against gold, which I believe that, but it's still not like Euro USD, right? Like every tick of Euro USD does is opposite of the dollar.
Yeah, because the dollar is at the end of Euro USD.
Well, but like, I'm talking about like Euro USD. Okay, just say GU and Euro USD, right? Euro USD will look the exact same as the dollar, but flipped around. But other pairs, like just say AUD USD, NZD USD doesn't look like Euro USD in the Dixie. You get what I'm trying to say? Like Euro USD is the exact opposite of dollar, I feel like.
Euro USD is the dollar is in 88% of all transactions. Euro USD is the most liquid Forex pair. And the dollar is the most traded financial instrument in Forex. So Euro is less traded than GBP. It goes USD, then JPY, then GBP, and then Euro USD. So that's why Euro USD looks like an opposite of the dollar index. Does that make sense?
Like every move, yeah, it makes sense. But I just feel like every move that the dollar makes, the Euro USD goes total like the exact tick opposite. The exact thing.
Some people say that. I've seen people show me charts like that.
Yeah.
There's an opposite correlation between the two that's very strong. That's just what that means. So
man, but I'm sticking to my one pair.
Yeah, no. I mean, to each their own.
I come to the dark side when I got everything figured out.
But I mean, ultimately, bro, it's just there are correlations and things, but you just have to know, like I said, your USD is the most traded pair in all Forex. It's the most liquid. So if the dollar index, and the dollar is on 88% of most instruments, so like majority of the Forex volume is Euro USD. Period. Like
that's crazy, but it don't go that many pips.
That's why, because everybody's trading it.
Oh, okay. And then what do you mean by is being the most liquid? That means, what does that mean?
By being the most liquid means it's the most interchangeable with money because there's so many people trading. So liquidity, I don't like the way most people explain liquidity, but liquidity is essentially means how quickly can you switch something from a tangible good to a fiat currency. That's what liquidity really means. So that's why I say it's the most liquid, because you like to trade stuff that has a good amount of order volume. And in order for you to close a buy trade, what has to happen?
A sell trade has to come in?
Exactly. That's why I hate the narrative that in order for you to win, somebody has to lose, because that's not the case. Somebody can just buy the opposite of your trade and they can make money off of it. So no, this is not a somebody wins to somebody loses type of thing. It's everybody could win, period. So when you actually understand the market, you realize a lot of these things are just bullshit. But so like when it comes down to it, Euro USD is traded by so many people. That's why that's not that much spread. The more spread that you see are the pairs that are not traded that often. That's why Euro USD has the best spread. That's also why it don't really go nowhere, because everybody and their mama trades it. It's a consolidating pair.
Got it. Everybody, tug of war.
Yeah, you're battling with so many people. Whereas a lot of the minor pairs like GBP, JPY, or CAT, JPY, when they take off, they don't come back because there's not that many people really trading in the first place. So you have to balance trading a pair with enough liquidity of orders and a pair that, it's not traded that much.
Got it. So. Makes sense. Never did it. Never understood it like that.
Most internet won't tell you. They don't really understand like this. Most internet's not going to share that with you. But yeah, that's the reason why. But yeah, is Euro USD probably the easiest pair? I know Rob is a big proponent of saying like Euro USD the best pair to start with. Well, I don't think he's wrong either. I think it's like, all right, it's knowing what you're looking for. If you're looking for a trend trading strategy, Euro USD kind of consolidates. But if you can really master like a GBP JPY, that's going to trend more than Euro USD. That's when you look at things like ATR, look at average daily movement, average daily range, because what that gives you is just the ability to say, okay, on average, this pair moves 50 pips in a day. But on average, this exotic pair, it moves 5,000 pips in a day.
Yeah, that's why I went to gold. I was looking up ADR and stuff. And gold is like moves like last year they said it was 224 pips a day, like to 180 to 220. I'm like, okay, I can deal with that. So that's why I went to gold. And I see like a lot of people don't trade gold. A lot of people don't trade gold. I see some people do, but not as much as EU.
Well, yeah, a lot of people don't. It just depends. Like, you really should pick pairs based upon your objective. If you're just scalping where 3 or 4 are, I think you can get out of EU. You can also do more ping pongs with EU because it tends to consolidate more. But I wouldn't try that same strategy on an indice or or on gold or pair that trends. So
yeah, I tried EU. It wasn't for me. I'm not into I'm not into like the tight stop loss. I'll do it, but it's just like it forces you to do it. Like I'm cool on gold. I'm cool on EU. I rather go to GU.
But GU is one of my faves too. Like that's the reason why. So
GU move like an indice sometimes.
Yeah, it does. It really does. Hey there. Hey Julio. So yeah, no. GU
Hey man, what's up?
How's it going?
Pretty good, man. I'm just listening. I'm at work, but I'll be listening.
Okay. Well, we're wrapping up anyway, so
Okay.
cut right at the end. But yeah, now like GU tends to move like an indice. GU has a high ADR. GBP NZD has a high ADR. AUD JPY has a high ADR. AU has a high ADR. GU does. That's why I look at AU and GU. I prefer them over EU, honestly.
Do you know where to look at the current ADRs right now, or how would you look at the ADRs?
You can look at average true range, or you can look at average true range, or you just they have like internet articles where they always tell you kind of ADR.
Yeah, I've seen it, but that was 2022, so I'm pretty sure they don't have it monthly. So the Asian session range that thing shows it, huh? The ADR.
Yeah, it'll show up for the sessions. Yeah. And you could use that to base an average too. But yeah, you get a pair with a high ADR, and then you just got to check to see like what's the size of the stop loss, because like let's say for instance a pair has 100 pip ADR, but on average you're taking a 30 pip stop. Well, it's only gonna give you a 3R. And if you go to another pair and it has a 50 pip ADR, but your average stop is like 5 pips, well then you're gonna get a 10R. That's how you can really understand like what is your average risk to reward probably going to be. Because I used to use the average true range indicator, the ATR indicator, and I used to always have it up. So I would say, look, if I have a take profit that's 50 pips, but the ATR on the trading time frame is like 2x, it's not even at 2x, the ATR on the trading time frame, it's unlikely I'm going to hit my take profit. So you can really understand if you're like overshooting your goals, or if there's something actually there that that you actually have as an opportunity. So I don't talk about it too much, but yeah, that's one of the cool tools you can use ATR for. So, but
yeah, I'm looking at gold right now. It's like everything was like the past week was like 200 plus. One was like 300.
Yeah, gold moves a lot, but you got to check to see, like I said, the stop loss too.
Yeah.
So that will help you. So, but all right, guys, appreciate the conversation and the questions. I will chat with y'all on Thursday. Don't forget, guys, that if you have any questions I didn't get a chance to answer, you can always ask in Discord. I always feel glad to answer anything I can in there, and also with our other student coaches. Definitely keep in mindful of this week. A lot of things happening, like I've explained, with the banks, and how's it going to affect the Fed, and what is the course forward. A lot of people are calling for a pivot. Let's see what happens next week. So be safe in your trading. I wish you all the best, many pips, no losses, and lots of wins. Take care, guys.
Hey, I got one quick question.
Mhm.
Do you remember your R's you used to get for gold? What was the average R's you used to get for gold?
Nah, I don't remember, bro.
Bro?
I have trading amnesia. I take the trade and move on to the next.
Yeah, that's why you great.
Well, I'll catch y'all guys in Discord.
All right, peace. Thanks.